This is the January 30 edition of Commodity Week.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Well, welcome to Commodity Week. I am Todd Gleason. Our panelists for the day include Naomi Blohm. She's at Total Farm Marketing out of West Bend, Wisconsin. Chip Nellinger is here from Blue Reef Agri-Marketing. He's in Morton, Illinois. And Sherman Newlin joins us, too, from Risk Management Commodities out of Hudsonville, Illinois. Commodity Week is a production of Illinois Public Media. Find us online at willag.org. Or search us out in your favorite podcast applications. Let's begin with a list of items that we should discuss for the day. Sherman Newlin, what's on your mind this week?
Oh my gosh, there's all kinds of things this week, right? Just heard a while ago that Trump announced he was still going to put 25% tariffs on Canada and Mexico, so that should make things a little bit interesting. There's so many things going on. We've rallied quite a bit. I mean, what do farmers need to be doing up and through here, I think, what are we going to end up with acres for new crop?
Chip Nellinger of Blue Reef Agri-Marketing on your mind?
I think we've got a full-fledged weather market as well with areas too dry, areas too wet in Brazil and Argentina. And so that's a big issue on top of what Sherm said about, possible tariffs. This fund position in corn is getting pretty excessive, too, probably north of 350,000 contracts. So are they going to support this long side of the market going into the new month?
And finally, Naomi Blohm, anything that we haven't discussed yet?
Well, we definitely need to talk about all of those things, absolutely. And add to it, we've got the big cattle inventory report tomorrow afternoon, and cattle markets having some price correction in the last couple of days, position squaring heading into that report.
All right, so let's begin with the Trump tariffs, because this is something that we have seen for a while. I'm not sure, Sherman, what you heard in the last few hours here on Thursday afternoon. The last thing I had seen was that the president was working through Canada-Mexico related to immigration, and then the trade part of those tariffs he was holding off until April the 1st. What have you been hearing on this Thursday?
Todd, I literally just 5 minutes ago on CNBC, they announced that Trump was going to implement the tariffs on 25% tariffs on Canada and Mexico. I think we're all kind of hoping maybe that would not happen, or, I guess now we got to wait and see, what does it do to the markets? Will they react more negatively than they have today? We see it is the end of the month. The funds are along quite a bit. We had some weakness today. So do they, take some more positions off in the corn and soybeans, because they are long a little bit of soybeans now, and just prepare for what might take place until something a little more clear shakes out, how it's all going to happen.
Anybody else have a comment on tariffs and the Trump administration and how to manage that kind of risk? I suppose you all have been thinking about it. Naomi Blohm, I know farmers are asking you, what have you been telling them?
Well, we've just really focused on having a balanced approach. And so for those who are making cash sales here for corn and beans both, we talk about, is it worthwhile to do any type of reownership strategy in case there's no trade war drama that occurs, or in case the weather in South America stays poor, or in case the U.S. has a weather issue down the road. So looking at fixed risk strategies, primarily bull call spreads. And on the flip side, though, there's some who are saying, you know what, I'm not going to price my grain for whatever reason. And they are looking at some shorter-term put option strategies to provide a price floor. You just can't discount the rally that we have had so far. Unexpected, of course, for many thinking with that surprise-friendly USDA report from a couple weeks ago. And now we're at the point where we've got $5 corn futures, and we've had a nice bean rally. So for prices to go higher from here, we would really need some significant friendly news to show up quickly. Otherwise, we might just see that correction lower. So you have to be ready for either scenario to unfold in the coming days.
And just for confirmation's sake, in the last 7 minutes, we started our program at about 5 after the hour of 3 o'clock. Bloomberg did report that the president would be following through on his threat with those 25% tariffs on both Canada and Mexico. So we'll see whether that holds overnight and what kinds of reactions we have from those two nations. Chip Nellinger, with that in your back pocket, what do you have to say?
Yeah, I think maybe you probably saw on top of the end of the month coming, probably the big reason why you saw some corrective action in corn and beans today. It doesn't seem to me like the market has factored in much of a chance of these tariffs or that they're going to mean much. And I think with Mexico being as large a buyer of U.S. products, ag products, top to bottom, I think it's a risk that can't be understated, right? And it's a big unknown. I think it's been overshadowed a little bit by the bullish weather scenario you've had in South America, and it could just increase the volatility. So there hasn't been much talk about China yet. I'm sure that's on the agenda. They're probably taking some low-hanging fruit first. Canada and Mexico, obviously, sharing borders with the United States, and that's probably important. But I would guess that in short order, we're going to have something announced regarding Chinese tariffs as well. And, I just don't know that the market has, focused much on that. So this could be a little bit of a bearish shock to the market, especially if the weather starts normalizing a little bit in some of these areas of South America.
Well, let's talk a little about the weather in South America. The meteorologists are of a mind, I think, that next week can be pivotal, though I am not convinced, I think, Sherman, that the Argentine crop has been hurt as much as maybe the trade earlier on suspected. What are you hearing about it?
Yeah, the crop is hurt some. It's still early in the game, and if they would start to get some rain, next week or the week after, I'm sure some of that will come back. I think crop ratings were a little bit lower again there today from Argentina, but it is early for them. If you get into the March time frame and mid-February, March time frame, and they haven't got a lot of rain, I think you're going to see some more reduction in some of their crop. The flip side of it is Brazil's going to have such a big crop of beans that they're going to probably make up whatever, easily whatever, Argentina's going to lose. And that we're still going to have a bigger bean crop out of South America. But there's also a lot of rain in Brazil, right? And that's hindering their harvest right now. So that's something that's going to have to be watched as well, because that is delaying to a certain degree, their second crop corn planting. So that's been, I think, some of the reason, the corn has had a little bit of more of a push to it here as well, besides the dryness in Argentina.
Naomi, what are you hearing out of South America?
Well, pretty much what the gentleman had just said there, not too much different. The concern, of course, being a slow harvest on that bean crop and getting it then exported, and then the slow pace of the second crop corn. But, to his point, at the end of the day, it's going to be a big crop of soybeans out of Brazil. And, they're pegged to grow about 169 million metric tons, and they export 105 of what they grow. So the world is ready to receive the cheaper South American soybeans, and I think it's going to be part of China's plan going forward here. They naturally switch over and buy beans from South America anyway, and so we'll just see how they tie that into trade and tariffs too.
We probably ought to discuss what you think producers should do as it's related to old and new crop at this point. I don't know exactly how to deal with the news from the president that he potentially or is putting on tariffs, and that may have changed by the time this program is airing. So from your perspectives, where should producers be at this time? And I guess, Naomi, I'll start with you and just work my way through Chip and Sherman related to old crop. Well, let's deal with old crop corn and soybean sales first, and what your expectations there are as to how far along they should be and what can happen with those sales. Things may fall apart in the overnight trade. It's just difficult to ask you that question, but where should they be?
Well, I would say with this recent rally that we've had, it's been just a triumphant opportunity for producers for old crop sales. So to be 50% sold, I think some are closer to 70% sold. So again, for prices to go higher from here, you need just this perfect combination of no trade war drama. We need bad weather in South America. We need immediately friendly news on the biofuels front regarding the mandates. And then we would have to have poor weather in the United States this summer. Now, if those four things happen, hey, you got a reason for prices to rally higher later on the summer. But you're kind of asking a lot to have those four things occur in order to have higher prices from here. So I think if you are not pricing the grain at that 50 to 70%, then make sure you're looking at some puts under the market to protect the value that's there, just in case we get the rug pulled out from underneath us.
Different versions of that, Chip, from you or from you, Sherman, and I'll start with Chip for old crop.
Yeah, when I get those questions from producers, Todd, I think it goes back to an individual case-by-case basis. I always ask a follow-up question. When do you want cash? If a producer's out here and they have cash rent and a bunch of inputs due and they want to turn their grain into cash by the 1st or the 15th of March, then I think you ought to be 80-85% priced with your finger on the trigger to get to 100%, maybe as soon as tomorrow or the first part of next week. If you want some ownership, do it with calls or call spreads. If you're a producer that says, no, I typically hold, 25-30% of my crop out into summer. I like to kind of see what's going to happen with the weather out there. That's a different scenario. I agree with Naomi. Get to 65-70% price. Hold the rest of it. It doesn't matter what happens in the short run on the grain you want to hold out into summer and play a weather scare potential or see what happens with the South American second crop corn. That's fine. But I think you ought to be a fair amount priced. And if you're not to that point, if you want to roll the dice and play on the bullish side, I think that I agree with Naomi. You ought to be thinking seriously, maybe as soon as tomorrow or overnight, at getting some sort of put strategy in place, because you just can't predict the weather. You can't predict tariffs. You just don't know what's going to happen in this uncertain environment.
And Sherman Newlin, and you can round the horn to new crop if you'd like to, please.
Right. Yeah, I don't disagree with anything they said. Percentage-wise, we've had a heck of a rally. I think a lot of people were surprised, from the numbers that the government put out on the yields. I guess we weren't overly surprised. Being a farmer, I've shelled enough corn and cut enough beans, and when corn's testing 12% and beans are 9%, 8%, you're going to have fewer bushels. But it was good to see that they finally cut the production size of it. But yeah, I think it feels like we want to try and before the tariff news, it sure did feel like we wanted to go through March, that $5 mark in the March contract, and maybe even tag 508. I kind of think if we would have got to 508, I'd really push a lot of old crop sales out the door, because you probably could be getting $5 cash at that point. And if you wanted to stay in the market, you could buy some May or July corn calls that aren't overly expensive and, not that far out of the money. So, pushing these sales, up and through here, I think is a very, very good idea for producers. Soybeans, if we can't get back up above, that 1074 mark we tried to hit the other day, that 200-day moving average, it kind of feels like we're on a slippery slope to the downside. In the soybeans, I think guys need to be cleaning up most, if not all, of your old crop soybeans that you have on hand. New crop corn, maybe a little bit in through here. I'm still not overly excited about where a cash price would be, but we are a lot, higher than we were, right? We are expected to plant quite a few million more acres of corn. So we're kind of waiting to see what that turns out to be. But if it's, if we do plant, some are saying, 4, 5, 6 million more acres, if that would happen, to me, that takes away from the soybean acres, not one for one per se, but, you take a lot of acres off the soybeans. I think new crop soybeans would have a chance at some point in time, maybe get it back up to that $11 mark. A few nuke sales in through here, 10%. Is not going to hurt anybody on new crop beans. I like the new crop November soybean chart. Kind of looking like it was putting in a head and shoulders type bottom. we're going to need to see some follow through with that. So I'm kind of holding off on some new crop sales.
Naomi Blohm, your new crop position at this point, and asking for a friend, should I sell 5% of my corn crop at $4.22? It's not a price that seems like something I like.
I would like selling new crop 10% sales at least right now. With corn, there's potential for the market to go higher if all of those friendly things happen, but more acres are coming in the United States, so that's going to steal the thunder. On the soybean side of it, even though we're going to lose acres on the beans, the world has record global carryout, and that is just going to be burdensome for a while. So you got to, take a look at the big picture, not just what's happening in our backyard. And with that November bean price at $10.53 today, you're probably, in some places in the country, you're going to get $10 cash. And I think I would take advantage of that because it's going to, like I said, we need a huge amount of continuous friendly headlines and stories to justify prices to go higher from here. And so I would just get something on the books.
And Chip Nellinger, your advice?
Yeah, I think we've advised being 15% priced on new crop corn and beans both. Close to current levels. We probably started in the low 450s, 453 on D's corn. Scaled up some more in the low 460s, 1040s. We started a little bit early and added to it north of 1050 on November bean futures. And then I think above and beyond that, I don't think it's out of the realm of possibility or, something that producers should really consider anyway, is adding some additional put strategies, maybe another 30 to 40% of your production on top of that. I think it's early on, right? Are we going to plant less acres of beans, more corn? Doesn't matter what we plant. We still got to raise it. We still are subject to weather issues. A lot of people saying we could be on the dry side from the weather community this summer, especially the Western Corn Belt. So you got to allow for that. But in the short run, I agree. I think the bean market, the world bean stocks, this large Brazilian bean crop that they're just starting to harvest, could weigh on things. I think the bean market is the weak link in the entire grain sector right now.
Now, Chip Nellinger, let's return to something that you wanted to talk about. And I think that certainly all of you have been following and may have some concerns about is the long position in the marketplace, particularly in corn, that the funds have at this point. Will the trade talk from the Trump administration cause them to take their profits?
I think that remains to be seen. I think it's coming at an interesting time where the funds, 3-4 months ago were short 150,000 contracts. Now they're long 350,000 contracts. You've got the end of the month coming, the start of a new month. They get paid on closed profits, right? Open profits don't matter to them. Fund managers get their bonuses and their incentive fees based on closed trades. I think that's going to be the question. I go back to what I said earlier. I think the weak link in this whole thing is the bean market. I think until you're assured of a big second crop corn in Brazil, which is more of a May timeframe, April-May type of a time frame there, that corn probably has a decent floor underneath of it. But you never know. What the markets don't like is uncertainty. You don't know what's going to happen with the retaliation or the reaction from Mexico, especially. Will they try to get all their corn needs out of Brazil and Argentina and bypass us? That's easier said than done. So I think the uncertainty certainly could cause some profit taking. Do they flip right back out and sell 350,000 contracts and get flat? Probably not. But if they took a third of that off the table, it would probably produce a 30-cent correction in the corn market.
Sherman, I know you talked about this earlier, but can you look back at the slow march higher that corn made from the October lows until recently and why that took place? And that the market, I don't know about missed it, but was not paying that much attention to it.
Some of it was what I said earlier. They know that, or they think that the dryness of the crop was going to come in a lot, bring the crop in smaller, right? because we as producers sure didn't know it. The trade sure didn't hone in on it, but we sure, thought it would be that way. And exports have been good, right? They've been above, expectations. I mean, we're above pace what we need to be at for, to meet USDA's exports. So I think the funds, we just pushed the market so low, right? And then maybe the expectation, once Trump got in office of maybe him working out, maybe doesn't look that way at the moment, some sort of a trade deal with some of these other countries to help everything has been very supportive. But yeah, they have gone from, very short to very long for some good reason. And it just kind of, the bullish factors kind of pile on maybe, a week or a month later, and now it seems to be the weather in Argentina, the weather in Brazil. It just kind of keeps boosting everything. And, I think the algos have been going with headlines and the market has just kind of kept running up on itself.
On the tariff side, Naomi Blohm, when you look back over time, and the president has referenced this, that there was a point where the bulk of the income that came into the United States government came from tariffs. That changed once the United States became a real-world leader after World War II. I'm wondering if you have concern that the president will follow through on the idea that tariffs are a way to fund the government and will leave them in place regardless.
Well, I think he's going to take a swipe at it. I think that, he said that right in his inauguration address. It was like high priority. So I think he'll give it a shot and see if it sticks and see how it holds. And it is just going to be touch and go as far as how the other countries respond to it. I also think, though, that the market kind of knows, in a sense, what to expect now with tariffs. So if we see a sell-off, I'm not sure that it's quite as dramatic as it was the first go-around, because now we know what to expect. And I also think other countries have been studying Trump a little bit better, and they know maybe more how to negotiate back with him in order to just endgame get the deals done. That's Trump's endgame. He just wants to get the deals done. So it is a unique time in our democracy to see how it is being led with all of these initiatives. I'll just leave it at that.
The Federal Reserve, Chip Nellinger, this week did not lower interest rates again, and it indicated that was just because it was waiting and unclear what impact the policies from the Trump administration would have on the marketplace, particularly inflation. Are you concerned? And if so, why?
I think they were right to pause. I think that your brain immediately goes to tariffs are inflationary, and they probably are by themselves. So I think the Federal Reserve was probably right to say, hey, we've ratcheted things back. Inflation has slowed just a tick. If we keep going lower, that could kind of reignite inflation in its own right. Let's wait a little bit. But I think as far as the tariff thing goes, the second go round here, to add on to what Naomi said, the first go round, the first administration of Trump, he didn't do much or wasn't allowed to do much more than the tariffs. And I think this time, just reading between the lines and what some of his advisors have said, it's a holistic approach, meaning they're going to try to cut a couple $1 trillion of fat out of the budget of the government. They're going to try to lower taxes. They're going to try to stimulate the economy. And so if all 3 or 4 of those things hit, it doesn't necessarily have to be wildly inflationary. And I think it's a little bit of an experiment. I don't know that there's anything we can go back in history and say we can relate to or compare it to. And so I think we're just going to have to wait and see. And I think that's the Federal Reserve's approach, probably rightfully so, is to let's give this a quarter, maybe 2 quarters, and see what is going to be put in place, what's going to happen. And, again, to Naomi's point, we saw it with Colombia, right? Maybe the market isn't concerned because it assumes we're going to get a lot of agreements and deals done instead of, 4 years of tariffs. So I think it's going to be interesting to see what happens the next several months.
And Sherman, anything else to add on this topic?
No, I mean, I agree. I mean, with what Chip's saying, I think the trade's, thinking that maybe Trump can end up making some sort of deal, like Chip said, with Colombia, and maybe things will come out all right. I mean, we sure don't want to lose Mexico. I mean, they've been one of our biggest importer of corn right now, and I think that would hopefully continue. But we need the demand to stay there, and hopefully, again, maybe they can work something out with China. I know China hadn't bought any corn for a couple of years, but any kind of agreement there or something would soothe the nerves of the trade and maybe would add to some bullishness.
Naomi, you mentioned the cattle inventory report that's due out Friday afternoon. What are you watching in this report? And I believe it was July that was not released last year. Is that correct?
That is my recollection. We haven't had a report for a year. So a year ago, the USDA forecast for all cattle and calves inventory was at 87.2 million head, which was the lowest inventory since 1952. Going into the report tomorrow, traders think that number could potentially be smaller than 87.2 million head like it was a year ago because of a larger drop-off in calves. And so, again, we're going to be having now the lowest cattle, potentially, inventory and lowest calf inventory since the 1940s. So the market is, I haven't seen any pre-report estimates for this report, so this is really challenging. We're going in blind, it feels like to me, to know exactly where we stand. So we're going to be balancing the report. We're going to be balancing watching tariff and trade with Mexico and Canada, of course, very large trading partners in the livestock industry, along with keeping tabs on the cash market and keeping tabs on what the funds are doing, as they're record long right now in cattle and feeder cattle. And we've already seen some profit taking heading into this report and into the end of the month, which triggered some technical selling. So there's a lot of moving parts in the cattle complex right now. Tomorrow's report is going to be, though, the springboard and the cornerstone for the February trade.
And related to the livestock side, avian influenza has reared its head again, and there are flocks in Illinois, Indiana, Missouri that have been reported to have this. Of course, those flocks will not be in the marketplace, Chip Nellinger. Are you concerned that between a smaller poultry flock in the United States, potentially because of the avian influenza, and the smaller herd size for cattle, that the feed numbers will be off in the future?
Well, there's always two sides to that story, Todd. When you talk like that, I mean, initially, yes. I don't think the lower numbers of cattle is anything new or surprising. We've known that's been the issue since the drought 3 or 4 years ago in the plains and the western Corn Belt. So there's always two sides to it, especially when you're talking about pork and poultry, because they can repopulate so quickly, and they'll have to. So in the back end of it, initially, when with lower numbers, yes, your feed demand goes down, your meal demand, your corn demand, but then as you rebuild, that can ramp back up. So it doesn't always have to be as dramatic or decimating to feed demand as what you would expect, assuming they build back those flocks and, wherever the issue might be. In pork and poultry especially, they can do it really quickly. In general, though, I think it's something that says on the cattle side, which is a big driver of corn demand, obviously, that hopefully over the next 6 to 12 months, we can start seeing some rebuilding of that herd and stabilizing or maybe expanding the feed demand. But it is a real question going forward. And then, the other question too, not to open too many cans of worms with one of your lines of questioning here, Todd, is, are we at a high enough level that you're starting to kill demand on beef? Because if that's the case, especially at a time where we may expand just a little bit, although I don't think you're going to show much on this inventory report, that's the kiss of death. When you kill demand and increase supply, things get really dicey at that point. So, supply is one part of it, demand is the other. I think pork and poultry have got a big boost from the high-priced beef demand, but you have to ask yourself, are we starting to choke back some of that beef demand big picture here?
Sherman Newlin, time to wrap up for the day. Let's begin with you at Risk Management Commodities out of Hudsonville, Illinois. Your final word.
Let's not forget, I think there's been a lot of farmers selling, going on this rally and right after the first of the year because producers, were running a little bit tighter on cash, so they sold more. So we don't have that hanging over our heads quite like we did last year. Todd, last year, farmers were holding on, and everybody was saying, well, that second harvest is coming because producers are holding on so much. So I think a lot of that corn is getting out of the producers' hands, and that's probably a good sign to help the market rally some more. But, we'll have to see what happens with these tariffs. How does the market react here in the next day? And then what happens next week and with the weather in South America. But I think you got to take a look at these prices for corn and soybeans both, and be quick on the trigger and get some sales put on the books.
Naomi Blohm from Total Farm Marketing at West Bend, Wisconsin. Your final word?
Just be ready for anything to unfold, and you've got to get back to marketing basics and understanding option strategies on reownership or protecting unpriced bushels, what it can mean to your bottom line, putting it into your total cost production, to your net results if we see a market reaction higher or lower, and what those strategies can mean for you. There's just so much uncertainty now, and we are at just a critical juncture here for these grain markets, and with everything happening in the world and with weather, that there's going to just be so much uncertainty going forward that you truly, truly, truly need to be ready for anything to unfold. But do reward the market with the value that's in front of you, and make some cash sales and just really focus on the value that's in front of you right now.
And Chip Nellinger of Blue Reef Agri Marketing out of Morton, Illinois.
Yeah, I think both those comments were spot on. I would add to it, from an old crop perspective, get a plan of attack. Figure out starting point. When you want that cash, if you typically need that cash and that grain generated into cash flow for March payments, cash rent, input, stuff like that, realize you only have 30 days left, and we've had a heck of a rally. If you hold it into summer regardless, you've got some more time on it. From a new crop perspective, as you look at what average yields are and what the input costs are, is nothing to jump up and down and get excited about. In fact, it may be barely break even, but that doesn't mean there are not some things to do by making a few sales initially, maybe looking at some put coverage, because there's tremendous amount of downside risk here, and we don't know the full size of the South American crop yet. And if things go on without a hitch with planting and the harvest of that second crop corn in Brazil, that's really going to be a cap on the corn market by mid-spring as well.
Commodity Week is a production of Illinois Public Media. It is public radio for the farming world. Find us online. Listen to the whole of the program anytime you'd like at willag.org. Our thanks again go to our panelists, including Naomi Blohm, Chip Nellinger, and Sherman Newlin. I'm University of Illinois Extension's Todd Gleason.